Our group consists of 5 members. My name is Natasyah, followed by Fatin, Najihah, Nabilah, Nurul, Asyiqin, and Athirah. So, without further ado, let's get started. And now, let's talk about our group company study, which is Fatin Cable Group BERHAD. This company is a Malaysian company involved in the manufacturing and sale of cables and wires, including power, communication, and control cables. Its products are widely used in industries such as energy, construction, infrastructure, telecommunication, and oil and gas. This company established in 1993, which is this company operates through several subsidiaries and employs about 689 staff, placing it in the medium to large company category. In addition to cables, the company also produces supporting products such as plastic compounds, wooden cable drums, and aluminium and charcoal rods. PIE Industrial BERHAD is a Malaysian investment holding company known for its work in electronic manufacturing service (EMS) for customers around the world. Since its establishment in 1997, the company has grown steadily and earned a solid reputation for producing dependable and high-quality electronic and industrial products. The company runs its business through 2 core areas, manufacturing and trading. On the manufacturing side, it produces a variety of items such as cables, wires, printed circuit board assemblies, cable assemblies, and other electronic parts that are tailored to meet the needs of different industries. By managing both manufacturing and trading under one roof, PIE Industrial BERHAD is able to provide smooth, integrated support to its clients. This setup helps maintain a stable supply chain, ensures consistent product standards, and strengthens the company's position in the competitive global EMS market.
Next, I will continue to trend analysis and evaluation. For my part, I will be presenting the liquidity ratio and leverage ratio of Fatin Cable Group BERHAD from 2020 to 2024. Firstly, I will start with the quick ratio, which measures the company's ability to meet short-term liabilities using its most liquid assets, excluding inventory. In 2020, Fatin Cable recorded a quick ratio of 1.69 times, which is the highest during the 5-year period, indicating strong short-term liquidity without relying on inventory. However, the ratio declined to 1.09 times in 2021 and further dropped to its lowest point of 0.95 times in 2022, reflecting weaker liquidity and limited liquid assets to cover short-term obligations. After 2022, the quick ratio improved to 1.32 times in 2023 and remained stable at 1.32 times in 2024, suggesting better management of cash and receivables in recent years. Next is the current ratio, which shows the company's ability to cover short-term liabilities using its total current assets. The current ratio was highest in 2020 at 2.22 times, indicating a strong short-term financial position. The ratio then decreased to 1.91 times in 2021 and reached its lowest level of 1.78 times in 2022, suggesting increased short-term financial pressure during that year. However, the ratio gradually improved to 1.85 times in 2023 and further increased to 1.93 times in 2024, showing a recovery in liquidity. Moving on to net working capital, which represents the excess of current assets over current liabilities. For net working capital, Fatin Cable records its lowest level in 2021 at 201,629 million. The highest net working capital was in 2024 at around 279,571 million, indicating stronger short-term financial capacity in recent years. Overall, the increasing trend of the 2021 shows improving liquidity and financial growth. Next, I will evaluate the leverage ratio, starting with the debt ratio, which shows the proportion of total assets financed by debt. The debt ratio increased from 40.38% in 2020 to 46.50% in 2021 before declining to its lowest level of 38.60% in 2022. However, it rose sharply to 47.98% in 2023, the highest value before decreasing slightly to 44.29% in 2024. For the debt to equity ratio, Southern Cable records its lowest ratio in 2020 at 67.72%. The ratio increased to 85.73% in 2021 and peaked at 98.22% in 2022, indicating higher financial gearing and reliance on debt. It then declined to 92.22% in 2023 and further reduced to 79.51% in 2024, suggesting an improvement towards a more balanced capital structure. Lastly, the time interest ratio declined to its lowest point of 3.38 times in 2022, reflecting weaker interest coverage. However, it improved to 5.13 times in 2023 and increased significantly to 10.65 times in 2024, which is the highest value, indicating a strong improvement in the company's ability to meet interest obligations.
Next, I will present the profitability ratio analysis of Southern Cable from 2020 to 2024. First, let's look at the gross profit margin. In 2020, the margin was 9.93%, but it declined in 2021 and 2022 to around 5.9%. However, the margin improved in 2023 to 7.02% and increased significantly in 2024 to 10.04%. This indicates that the company has improved its cost control and efficiency in managing production costs, especially in 2024. Next is the operating profit margin. The margin dropped from 6.47% in 2020 to 3.05% in 2021, followed by a slight improvement in 2022 and 2023. In 2024, it rose sharply to 7.56%. This shows better operational efficiency and improved control over operating expense. For the net profit margin, a similar trend can be observed. The margin decreased in 2021 and 2022, then improved in 2023 to 2.8% and increased significantly to 5.37% in 2024. This suggests that the company's overall profitability has strengthened in the most recent year. Next is return on asset and also return on equity. The return on asset declined to 2.14% in 2021, but gradually increased over the following years, reaching 10.03% in 2024. This indicates that the company is using its assets more efficiently to generate profit. Next is return on equity. The return on equity shows a strong upward trend. It increased from 7.96% in 2020 to 18% in 2024. This reflects a higher return to shareholders and improved financial performance. Moving on to the activity ratio, which measures the company's operational efficiency, account receivable turnover, and average collection period. The account receivable turnover increased from 3.56 times in 2020 to 4.27 times in 2024. At the same time, the average collection period decreased from 101 days to 84 days. This shows that the company has become more efficient in collecting payments from customers. Moving on is average payment period. The average payment period decreased from 37 days in 2020 to 27 days in 2024. This indicates improved cash flow management and timely payments to suppliers.
Moving on is inventory turnover. The inventory turnover increased overall from 6.33 times in 2020 to 7.33 times in 2024. This suggests faster inventory movement and better inventory management. Next is the fixed asset turnover and also the total asset turnover. The fixed asset turnover peaked in 2022, which is 16.86 times, and remained at a healthy level afterward. Meanwhile, the total asset turnover increased steadily from 1.26 times in 2020 to 1.87 times in 2024. This indicates that the company is becoming more effective in utilizing its assets. In conclusion, both the profitability and activity ratios show that Southern Cable financial performance has improved particularly in 2024. The company has strengthened its profitability while also enhancing operational efficiency and asset utilization.
Now, I will be presenting about a comparative financial analysis between Southern Cable Group Berhad and PIE Industrial Berhad for the year 2024. My presentation will focus on two main aspects, which are liquidity ratio and leverage ratio based on the graph shown. Let's begin with the liquidity ratio, which measures a company's ability to meet its short-term obligation using its current asset. In this section, we look at three indicators, which is current ratio, quick ratio, and net working capital. First, looking at the current ratio, PIE Industrial Berhad records a higher current ratio compared to Southern Cable. This indicates that PIE has stronger short-term liquidity, meaning it is more capable of paying off its current liabilities using its current assets. On the other hand, Southern Cable's lower ratio suggests a tighter liquidity position. Next, the quick ratio, which excludes inventory and focus on more liquid assets such as cash and receivable. Again, PIE Industries show a higher quick ratio, indicating that even without relying on inventory, the company is still in a better position to settle short-term debts. Southern Cable's quick ratio is relatively lower, implying greater reliance on inventory to meet immediate obligations. Lastly, we examine net working capital. The graph shown that PIE Industry has a higher net working capital compared to Southern Cable. This means PIE has more excess current assets over current liabilities, giving the company greater operational flexibility and lower short-term financial risk. Overall, based on liquidity ratio, PIE Industrial Berhad demonstrates stronger liquidity performance while Southern Cable appears to manage its short-term finances more conservatively. Now, moving on the leverage ratio, which evaluates how much a company depends on debt financing and its ability to meet long-term obligations. Here, we analyze debt ratio, debt to equity ratio, and time interest earned ratio. Starting with the debt ratio, Southern Cable records a higher debt ratio compared to PIE Industrial. This indicates that a larger portion of Southern Cable's asset is financed through debt, which increases financial risk, especially during economic uncertainty. Next, the debt to equity ratio shows a similar trend. Southern Cable has a higher debt to equity ratio, meaning it relies more heavily on borrowed fund than shareholders' equity. In contrast, PIE Industrial maintains a lower ratio, suggesting a more balanced capital structure and lower dependence on debt. Finally, looking at the interest earned ratio, PIE Industrial shows a stronger ability to cover interest expenses from its operating income. This indicates that PIE is more capable of meeting its interest obligation comfortably. Southern Cable's lower ratio suggests that interest payment may place greater pressure on its earnings. To conclude, based on both liquidity and leverage ratio, PIE Industrial Berhad demonstrates a stronger overall financial position in 2024. The company shows better short-term liquidity, lower financial risk, and stronger ability to manage debt. Meanwhile, Southern Cable Group's Berhad, although still financially stable, carries higher leverage and relatively weaker liquidity, which may increase its exposure to financial risk in the long run.
This slide presents a comparison of the profitability ratio between Southern Cable Group Berhad and PIE Industrial Berhad, focusing on how well each company generates profit and use its resources. First, we look at the gross profit margin, which measures how efficiently a company manages its production costs. Southern Cable shows a higher gross profit margin, indicating better control over cost of goods sold and stronger pricing power compared to the PIE. Next is the operating profit margin, which reflects how effectively the company controls its operating expenses, such as administration and selling costs. Southern Cable can record a higher operating margin, suggesting more efficient day-to-day operation. The net profit margin measures the company's overall profitability after deducting all the expenses, including interest and tax. Southern Cable slightly outperforms PIE, showing that it is able to return more profit from each ringgit of revenue earned. Moving on to efficiency ratio, return on asset ROA shows how well company use the total asset to generate profits. Southern Cable has a higher ROA, indicating more efficient asset utilization. Finally, return on equity measures how effectively the company generates return for its shareholder. Southern Cable records a higher ROE, meaning that shareholders receive better return compared to the PIE. In conclusion, based on this profitability ratio, Southern Cable Group Berhad demonstrates stronger profitability, better cost control, and more efficient use of asset and equity, making it financially stronger than PIE Industrial Berhad for the period analyzed. This slide shows a comparison of the equity ratio between Southern Cable Group Berhad and PIE Industrial Berhad, which help us understand how efficiently each company manages its operation, working capital, and asset. First, looking at receivable management, Southern Cable has a higher account receivable turnover, which means it is more effective in converting credit sales into cash. This is supported by a shorter average collection period, indicating that Southern Cable collect payment from customers faster. On the other hand, PIE takes a longer time to collect its receivable, which may affect its cash inflow. When we look at the average payment period, PIE has a longer payment period compared to the Southern Cable. This suggests that PIE delay payment to supplier and make greater use of trade credit, which helping to preserve cash in the short term. Southern Cable, however, paid supplier earlier, reflecting a more conservative and disciplined payment approach. Next, in terms of asset utilization, Southern Cable consistently outperforms PIE. Its inventory turnover is higher, meaning inventory is short and replaced more quickly, reducing holding costs and the risk of obsolete stock. Additionally, Southern Cable fixed asset turnover is stronger, showing that its machinery and equipment are used more efficiently to generate sales. Finally, the total asset turnover further support this trend, as Southern Cable is more effective in using its overall asset to produce revenue compared to the PIE. In conclusion, Southern Cable demonstrates stronger operational efficiency, faster cash cohesion, and better asset management overall. In contrast, PIE relies more on delayed supplier repayment and show lower efficiency in turning asset and receivable into sale.
SCGB excels in profitability and operational efficiency by achieving higher margins, GPM, OPM, and NPM, and superior returns on assets and equity, ROA, ROE. SCGB is more effective at converting its resources into profit. However, this performance is driven by higher financial leverage, while this aggressive capital structure fuels growth. It also exposes the company to greater financial risk and liquidity fluctuations. The final one, investors prioritizing capital preservation and stability should favor PIE, while those seeking higher profit potential may find SCGB attractive, provided they can tolerate its higher debt profile. Overall, PIE Industrial Berhad is the financially stronger, less risky company, offering stability and reliability, while SCGB provides higher profitability potential but with greater exposure to financial risks. Investors seeking safety and consistent liquidity may favor PIE, whereas those seeking higher returns may consider SCGB, keeping in mind the associated risk. Thanks for watching this video. Don't forget to like, subscribe, comment and share. That's all from us. Bye bye!